at one time, finance used to be basically essentially an accounting function, or accountants, and they used to be called bean counters. The term bean counter actually originated in US, but the whole idea was that they basically keep a track of where the accounting, the record keeping, the control on cash. Why do you want to spend? Why should I give you money? Why I'm not getting money in time and all this. So a term a bean counter was actually was in vogue for quite some time. Actually, that was also the time when capital was easy to get to, at least in the Western world, and there was really no strategic or a business role for the accounting function. Their job was to basically keep a track, keep accounting, and then ultimately present to the management what is the result of the business operation in terms of profit and loss account, and what does the business own, and what does it own, and what does it owe, what is called a balance sheet. So this was the basic function. But then what happened was that that as the years rolled on, the business complexities increased. Capital became scarce in the sense that more and more people were competing for the same amount of capital. Then also, of course, as far as regulators are concerned, for example, the stock exchanges, they became very highly concerned about the quality of the accounting, the quality of disclosures. Ordinary people, I don't know how many of you remember there's something called a Harshad Mehta scam, but then thousands of crores of money was lost by simple people, including taxi drivers, who put all their hard-earned money into stock market only to see it all disappear within a relatively short time, and they never got that money back. So regulatory compliance is increased, and progressively finance as a function came to occupy a central role in the management of the business, or of the enterprise, as we call it. Now, sorry. So, that is how. Now, so then I will now show to you what actually. Some of you might be wondering, and sometimes I also want to kind of tell you that today's finance function, if you see, these are what 5, 7, 8, 10. I just articulated here 10 areas, but actually there are more. I'm just pointing out to what is the role of finance as finance function, but not a role of finance function in managing the business side of the risk, or performance management. Some part is there. So I'll just kind of give you a kind of brief introduction to all of this. Okay, so then financial accounting, I think most of you understand, and financial accounting is basically, all of you would know about profit and loss account and balance sheet, and I'm not getting into that because that, I'm presuming, is generally known, and I'm quite sure some of you or many of you would also be investing in stock markets and looking at money control, and others where you get all the reports of your shareholders, and you get annual reports through a link nowadays and not hard copies. So I'm assuming that but basically financial accounting, the whole idea of financial accounting is to keep a track as to, one is to, of course, summarize what has been the result of the business operation, but also keep a track on all the transactions, and are there, for example, financial accounting also includes something called internal controls. Internal controls basically mean that that there is no fraud, that there is no misappropriation of funds, that systems and processes are strong and stable, such that if anyone is indulging in a wrongdoing, there is more than a reasonable chance that it would be caught. Now, I just want to tell the young people who are here that the business is different than the owners, and the business is different than the shareholders. A business is ultimately a sum total of all of you, but the business has its own form. It's a legal form. It's not a tangible thing. But a business, we'll call it company, for example. Right now, you can have business by any definition, but it's called company. So a company is distinct from its owners or its shareholders, and the concept is that the business is supposed to be in continuity. People will go, people will come, people will fade away, new owners will come. The business will continue because business is an economic entity. While the people who ultimately make that business, they in a larger sense are perishable, because all of us are ultimately perishable, except that we have a longer perishable time when God will call us away. So therefore the systems are designed that everybody is honest, but the system needs itself to be strong, that humans have their fallibility as well, and some of them would try to game the system or to try to take undue advantage or take out money or do anything in any form. So therefore financial accounting is a model of that. The asset control function basically is actually a subset of financial accounting, but it basically keeps a track of are assets there. What the business is saying or what the accounting is saying, that this is the X amount of assets I own, whether they are there or not. So there's generally a system by which at least once in 3 years, all the plant and equipment are generally physically verified by an external set of auditors. For companies which are far-flung and have multiple locations, today now you also have geotagging. So you can actually use geotagging for keeping a track of the assets, and if there's any movement which is not authorized, it can be caught. Asset control is actually a critical function because history is there of both ways. Fictitious plants. So companies have borrowed money but never put up a plant but showed that they have assets. Just on the other side. Other side also is sometimes at far-flung locations assets have been stripped and company does not even know that what it thinks its assets are is actually not there. They have simply been passed over by a combination of corrupt employees and corrupt security. As I said, business assumes it is going to continue, and therefore all these control systems are established. But asset control is a critical function within the domain of finance. Now let's talk about something more interesting, cash flow management. Now, when I say cash flow management, understand one thing. Profit never means cash. Profit is a derived figure, which in very simplistic term means that you sell and then you buy material and employees are paid and facilities are to be paid for, offices, plants, power, and ultimately there's a surplus between what you sell and the cost that you've incurred. That you get a profit, but then government doesn't leave you. So government says, okay, fine, you have now made profit. Now what about my share? Because I ultimately provide you the infrastructure, the roads, the bigger power lines, industrial state that I developed through industrial state corporations and blah, blah, blah. and therefore you have to pay my share, so you pay tax. And once you have paid tax, then you get something called figure of net profit. But the fact remains is that that profit doesn't mean that you actually have cash in the hand. I'll explain to you an example in the next slide. The dictum is also there that it does not matter. I mean, it of course matters, but recording a high profit is nothing as compared to recording a high cash balance. Cash is king. That is an overriding dictum. If you talk to any senior player, a person who has worked in companies across multiple sectors, they will always tell, we are only concerned whether I have enough cash or not. Because there are hundreds of examples where companies are gasping for cash despite showing that they have a lot of money. They have a lot of profits. Now, there's one thing quick I just want you to understand, that if you see a financial statement, it's not jargon, but or you otherwise also know there's something called depreciation. Depreciation is basically what? It is the loss of the economic life. Estimated the economic life of an asset. Like technically, if our working career says 40 years, and if my working capacity is 100, with every year passing, 2.5% of my economic capacity, which is 100%, goes away because of the time and because I use that. So an asset, as you know, when you manufacture something, you use a machine, that ultimately machine has an economic life. You can extend the economic life by better maintenance, etc., but ultimately it has an economic life. And after a certain time, that will have to be replaced. So depreciation basically is a charge, or is the amount that is treated as a cost, which means a fund which you are not allowed to distribute. This is also as per law. But depreciation is only a notional charge, it's not a cash charge. And therefore, when we say, do I have cash or not? So I first take a term, do I have cash profit? And the cash profit basically means I add my depreciation to the net profit. That's called cash profit. Very simple. Net profit, if you see in any company's profit and loss account, you always see a figure called depreciation. That's a mandatory disclosure. You add that and you ultimately get a cash profit. Now see this slide. So what we are saying? We are saying, look, there's a company which has 100 crore rupees of profit, net profit. Now you will all agree with me that 100 crore rupees of profit is a damn good profit. It's a nice profit. And let's say that you have a depreciation charge of 20 crores. That is the estimated loss of economic life of an asset expressed in rupees. So let's say 20. So how much is the cash profit? By what I told you, the cash profit is basically 120 rupees, 100 plus 20. But see this. This cash ultimately is to be deployed, or generally gets deployed, right? So how does this cash that the company earns actually get used? First, let's understand very broadly, right? So you will sell, but your customers say, gentlemen, I'm happy to buy from you, but I need 60 days credit. So you know that money is going to come to you after 2 months. So let's say your 2 month sale is 50 crores. Now you have sold. You actually have sold material plus your profit markup worth 50 crores, but you have still not seen the cash because you say, I'm going to give you after 60 days. Let's now come to something more interesting. Okay. One of the functions, you saw this 25 crore, right? Negative. So ultimately somebody has to fund it. No? Otherwise you will run out of steam, you will not be able to operate. So one of the critical functions that finance does is trying to raise money. Now, this is just for your information. I'm not going to get into a detailed explanation on how to raise money. I spent all my life doing that, earlier life at least, for 13 years. When I was working in a company which was smaller than yours when I started. And I have gone through the pain of trying to raise money. But today, you have a lot of options. Particularly for startups, there is tremendous option if you are able to convince that you have got a good product. I'm not talking about what you see in the Shark Tank, but the fact is that actually money is available for European equity partners, because simply the people, particularly private equity and VCs and venture capitals, even more, are now so much there. Their job is to invest and support smaller companies and companies which have a brighter idea. For startup companies, of course, equity is the most preferred route in the beginning, but do keep in mind that equity is the most expensive form of capital. There is a lot of theory behind as to why equity is there, but the fact is that equity is a very expensive form of capital. To just give you a very simple idea, if I'm a shareholder or if I'm an equity financer, why should I give money to you? What options I have, for example? Now, if I have money as an investor, I will say, look, instead of giving it to you, why should I not put the money in index fund? Now, for example, if all of you who do not know, Bombay Stock Exchange started in 1979 effectively, and since 1979 until today is compounded CAGR, called compounded annual growth rate, or the returns it has given is about 15%, which means every year it has generated 100 rupees became 115, and then 115 into 15%, and like that has continued. So he will say, why shouldn't I do? Or even from 2000, the BSE index has given a return of about 11%. So let's take 11%, because before 2000, economy was very different. So let's say from 2000. He will say, guys, if I can make 11% money there, why the hell should I give it to you? Because I'm taking a risk. Tomorrow your business fails, my money goes. So therefore, I need more. I need at least 4-5%. If I'm a regular investor, a venture capital investment, by the way, for risky enterprise, they expect 30% return on their investment, just for your information. So while you can take debt from, let's say, SIDB, which is for smaller companies, at about 9 to 10 or sometimes 11% today, for equity, nothing less than, let's say, size of a small company would be at least 18 to 20%. So equity actually is much more expensive. Now, how will he take the return is different. That he will ask for, he will say, okay, give me X amount of equity into your company, and therefore the owners will have to kind of shell out a much more portion of the equity that they would like to. But in principle, equity is more expensive, debt is less. But so you can have equity as a finance, you can also raise debt. Depending upon the size of your company, there are many types: banks, SIDB, non-banking financial companies, for example, Edelweiss Finance, you have Birla Finance, you have Tata Finance, they all give money to companies. So there are multiple options. At one time in my earlier career, there was not even a single, practically there was no single, I'm talking about 83 to 85. Some of you were not even born at that time, for sure. But then those times there were not as many avenues, but there was no avenue that I had not raised money from. I raised money from IDBI, IFCI, ICICI, 4 banks, Army Group Insurance Fund, Naval Group Insurance Fund, Air Force, you name it, I had taken money, including Life Insurance Corporation. But today, those days were very difficult. Today is much easier comparatively to raise money. And of course, then there are subsidies, which, a lot of central and state governments still offer services. For example, Ministry of Information, that MIT, they call it Ministry of Information Technology, they actually give outright grant up to 40 lakh rupees also for startups now. So there are a number of subsidies, grants, which are available. But the point is, what arises the shortfall here is what then the finance guys step in to try to raise money to bridge the gap. That is one of their critical functions. All right. A critical part of the finance part is managing financial risk. Every business has a lot of risks. There's business side risk, there is other risk, there are physical risks, but a very important component of management of business is called financial risk. Financial risk is like what? The balance between the amount of debt and equity could be out of whack. So it endangers your survival. If you have borrowed money, interest rate could go up or could go down. If they go up, then you run that risk. If you are exporting, currency movements impart a risk. Funding shortfall, I have already discussed, is a cash flow risk. And then there's another element of broader economy risk called inflation, global markets. You know what's happening in Ukraine. You have banks failing. In India, monsoon failing. There are a number of other macroeconomic items that also increase the risk to the company. And what the finance professionals do is that, if you see below when you read that there are a number of things which are available for mitigating risk. You can never say, I will never have risk. Then you just need to put money into stock exchange, index fund, or into a government of India bond security. So long as you're running a business, you'll always have risk. Risk you can never avoid, but the risk needs to be managed. There are hundreds of risks, but I'm talking only about the financial risk. So this is where I will just kind of put a full stop. And now, if there are any questions, I will be very happy to answer.
So let me ask. You said 30% is the what these financial institutions are expecting.
No. That's
so
only,
is the WACC, weighted average cost of capital, we should consider 30% as the equity cost of equity? What? How do you put a number?
Okay, no. The 30% was only for venture capital funds. Venture capital funds are the one who will basically fund an idea, not in case of a running company. So I was saying that if, for example, I was just giving options of what is available. But if you were to borrow money from venture capital, basically means they are funding an idea they don't even know will succeed. But if you are running business, Harish, if you are running business, I would say that well-established company would have an equity cost at about today at about 14%, while the cost of debt, because debt is tax deductible, the cost of debt could be as much as net 5% or 6% at the most, and then depending upon the percentage of equity and debt in the total funding, you actually get out your WACC. For a new company, I mean, for a company which is young, whose idea is proven, it has sales, but it is still not there. It is still trying to find market for its product. It's still developing a new products. I would say a cost of equity would not be less than 20%. I mean, if I'm an investor, I will not put money if I'm not able to. If I just put equity with the risk today, so it's like this. If in a well-established, in a kind of well-established company, if I am prepared to, if I'm expecting 14% return at least, then anything between 5 to 6% additional cover, I need a margin of safety for investing in a company which is just 3 years old and might just wind up because it can't get enough money to either develop more products or find a market or no. I mean, the risk basically is high. If for something like Thermax or company like this big, if today I can get a AAA bond investment I can get at about 9% today. So, and I'm still expecting 5% more. 5% on top of that, I definitely expect. So, and of course, the cost of debt would be slightly higher in case of a new company because the risk is higher. But you get the drift. It is never 30%. 30% is only for people who are just funding an idea. That's what venture capital do. So I would say that depending upon what's your targeted equity and debt or your current equity and debt, between 18 to 20%, you could take your cost of equity and then, say if you are profitable and you are, and in any case of debt, you could take, if you were able to get 12 and 30, yeah, so maybe about 7-8% would be your cost of debt. So if you're 50-50, well, your WACC would then come to maybe about 14-15% is what I say.
I had a couple of questions, sir. One is during the resolution process, once an RP is appointed, okay, sir, does the company actually operate, run normally, or to what extent is it able to run normally? That is one. Second, more of an academic question, since you have great experience in looking at both this NCLT current process as well as earlier processes. How would you compare? I mean, in the earlier days, we had something like a restructuring, and sometimes there used to be this funded interest term loans. Sometimes, the sustainable and unsustainable parts used to be separated, and sometimes it would be converted into equity. Why I'm asking this question is some of the haircuts that we are seeing are really too high. I mean, unbelievably high. I mean, so do you think this process is really helping banks, as compared to the earlier mechanisms that were there? Thank you.
Okay. First, of course, is the intent of the code or intent of the act is to actually so the dictum is RP will do all what he can, of course, to the extent he can, but he will do all what he can to see if the company can keep running. Now, for example, in case of Alok, later on the employment, because some of the people never came back after they thought the company is going, but it continued to hire 15,000 people.
Okay.
And continued to get, everybody got his salary paid, the company continued to work. It was always positive. And but initially I had to take 150 crore rupees interim finance to sort of pay off critical suppliers, so that, or so the company does today, Indian Steel, for example, where I am currently the RP, is before when it went to NCLT, it had a cash of 10, today it has 40 in terms of crores. So yeah, the intent is that a company should, and that is actually one of the, I mean, it's like, unless there's absolutely no option, or if the company is already dead, then company should keep running, or at least RP has to do to keep on running, at least to the extent if he can pay off the supplier, pay off the employees and things like this. That's one. Now, you need to be clear here that you have come to the NCLT because everything else has failed. Are you getting me? Because your sustainable versus unsustainable debt, your the joint committees, your restructuring loans, refinancing loans, everything failed. Because they failed, the company has to. Now, what only has happened now is that it was realized. For example, when you say, actually, the moot question to answer is, how could a debt go up to 29,000 crores? For something that started with the 5,000 crore rupees borrowing. So the question is the failure of all those past mechanisms, the history, is that those have not, no doubt that some of the companies have benefit, but largely, largely, if these were to be successful, then this point, the NCLT, there would be no need to come to. NCLT is when everything else has failed. What do I do now? So when RPA realized that,
Okay.
Then, guys, now you have SM0, you have SM1, SM2, and then if not there, either you have 1 year to sort it out. If you can't sort it out, it goes to NCLT. The reason being is that you are avoiding years and years of all those failed attempts, and the value it just keeps on deteriorating. And of course, as far as law is concerned, against the winding up law and this thing, I mean, those are complete disasters. Here, at least recovery. And of course, when you say recovery, basically also just keep in mind, with Rajan, that a lot of them is actually compound interest and interest on interest and panel interest, which keeps on.
Right.
Keeps on.
Understand, sir.
Yes.
Understand.
Though technically, actually, my heart goes out not so much to the bankers, honestly, because it's their business to understand and price risk, and they have a lot of control which they have failed to do. Who gets hurt in the process is the poor supplier.